Today, I'm talking with one of the nation's foremost experts on what it takes for you to qualify for a mortgage loan on income property today. I'm talking specifically about investment property that you're not planning to live in yourself. So we're talking about things like your minimum credit score and like your debt to income ratio maximum threshold. And gosh, that DTI, that debt to income ratio, that was the thing that really held me back from qualifying for more income property earlier in my investor days. We're also going to talk about, in today's high appreciation environment, are appraisals keeping up? And more toward the end of this chat today, we're going to talk about DSCR loans, debt service coverage ratio loans, and why Chaley tells you that this is the easiest way that you can qualify for a mortgage loan on investment property today. Hey, go ahead and put a like on this video if you like that we're talking about this topic. We really get into some details here in just what it takes for you to qualify for an income property today. I'd like to welcome in the president and CEO of Ridge Lending Group, and importantly, she is a real estate investor herself, and Ridge has helped more families realize their dreams of homeownership as real estate investors than any other mortgage lender in the entire nation. Welcome back to GRE, Chaley Ridge.
Hey, Get Rich listeners, thank you for having me, Keith. I'm very happy to be here with you all today.
You know, Ridge Lending Group, they specialize in income property loans, so you just don't tend to have those problems or wrinkles that you have with some of the other companies where they specialize in owner-occupied loans. In fact, Ridge Lending Group is where I got my last few income property loans and where I did my last few refinancings. I have physically been inside their main offices, and, you know, right on their website, they even have a core value of, thinking and investing through an abundance perspective rather than through a scarcity perspective. So they're so aligned with what we do here. But, interest rates are changing all the time, and so does the mortgage industry. But, Chaley, I think with mortgage rates being a newsworthy item lately, it's interesting to talk about just where we're at with mortgage rates now, to at least lend some historical perspective to this. And I think it's important to get that because in 1981, 30-year fixed mortgage rates topped out at over 18%. In the year 2000, they were about 8%. And in the year 2010, rates were about 5%. Now, I know since really January of this year, the 30-year fixed rate really started up its climb from about 3% to about 4%. But why don't you just talk to us today with where we're at for mortgage rates?
Interest rates is always one of the hottest topics that we talk about day in and day out with our clients. And you're right. People tend to have kind of short memories on occasion when we talk about the long-term mortgage rates. As an example, too, just to add to what you were saying, pre-pandemic, for those that are interested, we were in the 5.5% rate range for investment properties. We're still below that. So I'll go through a couple of examples. Those of you that have heard me talk about interest rates before, this might just be kind of a recap, a reminder. But I want to start by saying that, like anything else, rates are not created equal. Okay, we have to very clearly define the characteristics of the transaction in order to get us the appropriate rate that would be attached to that loan. These variables are things like the occupancy of the property. We're talking about non-owner occupied, a very different rate than an owner occupied.
Right.
The loan size, the loan to value, the property type. Is it a single family residence? Is it a 2 to 4 unit? The credit score that you come with, all of these variables have their own unique price adjustment. I won't get into all of the weeds of that, but let me quantify for you what we're talking about today, and then I'll get you guys some rates, and then I want to put some other things into perspective for everybody. So we're going to assume a single family residence. We're going to assume that this is a purchase transaction. We're also going to assume that the individual has a 760 or better credit score. And I'm going to look at this both from a 75% loan to value and an 80% loan to value. And that's the perspective that I was talking about, just to give people that baseline, because I think that there's a psychology behind the actual number of the rate and not really doing the math. And then the light bulb goes off, et cetera. So I did some work getting on camera with you today, Keith. And so again, 150,000 at 20% down, our loan amount will be 120,000. The rate you'd be locking in today would be 5.25%, 760 credit score, single family residence, purchase transaction. The principal and interest payment at 5.25 on 120,000 is $663 a month. Let's take that scenario at 25% down. Our new loan amount is $112,500. The difference there is $7,500 of capital expenditure, right? 5% of 150 is 7,500. 4.75 would be the interest rate at 25% down, yielding a principal and interest payment on 112,500 of $587. The payment difference, principal and interest only. We don't care about the taxes and insurance. Those are static. They're going to be what they're going to be.
Right.
But the principal and interest payment between these two is $76 a month. The math you guys want to do is you want to take 7,500 and simply divide it by that $76 a month payment difference. That math is going to tell you how many months it would take to recapture the upfront capital versus the savings, right? That ends up being about 8.22 years or 98 months. Keith, I think that I'm fairly confident to say that you'll agree that the leverage, when you do that math, the rate of return on that higher leverage is really where you want to be. First of all, you've retained $7,500 that you could use to deploy for another investment, and I'm certain probably make up at least $76 in cash flow somewhere. Or if you wanted to, you could simply keep your $7,500 and pay yourself $76 a month for 8 years, right? I mean, so I think what I'm saying is that leverage generally is going to be the winner. Interest rates as they are today still lower than we've seen them in some time, historical lows. And then I think it's important to also highlight that when rates go up, we always see rents follow. It doesn't happen at the same trajectory, but they will get there. So keep that in mind as well.
That's right. When rates go up, it reduces affordability for those most vulnerable first-time homebuyers, and that keeps them in the renter pool. But yeah, to your point, Shaylee, generally, I am in favor of leverage over time. With the example you gave there, it's a difference between 4-to-1 leverage with 25% down and 5-to-1 leverage with 20% down. It is interesting, however, that there is a 1/2 of 1 point interest rate difference between 20% down and 25% down. That's more than I would have expected.
Yeah, 1/2 point. And that's today. Remember, secondary markets have a way of dictating, where that spread is going to be. There's a lot of variables that play into how the rates are going to fall for that particular day or even that time of the day. Inflation right now, we've talked on this before, Keith, is playing a role. Certainly, I hate to speculate, but what's happening in the Eastern Bloc and some things, the news headlines of all of that, we may find a little bit of a reprieve. Generally, I feel like for mortgage-backed securities and the long-term bonds, if there is volatility in that uncertainty sector that might require, U.S. troops, anything that happens there, we may see rates come down a little bit as a result of that. That's generally the rule of thumb is that when you have a lot of uncertainty on secondary markets related to things outside of everybody's control, we might see a little improvement in rates.
Yeah, it's strange. Uncertainty can actually be worse than bad news for these sorts of things. But yeah, Shaylee, we talked about mortgage rates and spreads and so on. Why don't we talk about the spread between mortgage interest rates for an owner-occupied primary residence homebuyer and a non-owner-occupied, an investor property loan? What is the spread between those two, and what is that dictated on?
Yeah. So really, it's just the occupancy. I mean, if just as a general rule of thumb, you're typically going to find a 1% spread between just the occupancy. But remember, those other variables that are going to dictate or play a role have a huge impact. If we're talking about a 75% non-owner occupied cash out versus a 50% rate and term owner occupied transaction, it'll probably be a bigger spread than just 1%, right? Because the lower the risk, the better the rate, the higher the risk, the worse the rate, I guess is another way that you can kind of quantify it. So primary residence, less risk than a non-owner occupied, a rate and term, less risk than a cash out, a 50% LTV, less risk than a 75. So all of those things kind of have a balancing act attached to them.
We're talking about what's called that risk premium that a lender adds onto a property because an owner of that property is more likely to walk away if they don't live there themselves.
That's true. The philosophy, that's what the investor is kind of basing the price adjustment on. I may argue that point just because I remember what it was before the 08-09 debacle of housing and lending. Fogging a mirror was all you needed to do to get a loan. The sweeping legislation related to investors and mortgage lending, you have to walk on water now to get a loan, right? So the criteria to qualify, you have to have very high credit scores. This is conventional lending, obviously, we're talking about very high credit scores, lots more skin in the game, assets, lots more assets. So all of these things now, I think, preclude some of that risk. And I feel like it should kind of be relooked at, but that's not this decision for me to make. Just my soapbox, I guess.
So even though mortgage interest rates have been up in the past few months, they are still historically low. So of course, borrowing 80% gives you more of that borrowing power than borrowing at merely 75%, as well as the leverage component. So Chaley, why don't you just go ahead and talk to us about what it does take now to qualify for a non-owner occupied property, a rental single-family home up to fourplex, with respect to down payment and debt to income ratio and those sorts of standards.
There's three primary baselines for qualifying: credit, assets, debt to income ratio. Let me talk quickly about the difference in leverage opportunity between the property types. A single family residence on a purchase transaction, you can actually leverage as high as 85% loan to value, where you're putting 15% down. In this case, and that's for single family only, you will expect a higher interest rate, slightly higher interest rate. And of course, anything over 80% loan to value conventionally will have PMI attached to it. This is private mortgage insurance. I would calculate a factor of 0.52% if you're going to try and do this math for yourself. Simply take the loan amount. So easy math, if you had a purchase price of $100,000, 85% of that is $85,000 is your loan amount. Take that number times 0.52%. You're going to get a number, divide that by 12 months, and that will be roughly what your PI payment will be on that particular transaction. That's for the single family. Some people don't love the idea of PMI. I think you should look at it with both aspects, see how the numbers play out. The math won't lie. Anyway, 2 to 4 unit, 25% is the maximum loan to value, so 25% down on a duplex, triplex, fourplex. The qualifying criteria, those three pieces: credit, assets, and debt to income ratio. Credit, if you have 6 or less finance properties, you could have as low as a 650 credit score and probably get qualified if you had a low DTI, debt to income ratio, or strong assets. Those are compensating factors. Once the individual reaches a 7th finance property and up to 10, still within the conventional guideline space, they must maintain a minimum middle credit score of 720 or greater. There's hard and fast, no getting around that. Assets, so you need your 20 or 25% down, or 15% if you decide to go 85%. Your assets need to be sourced and seasoned. This just means that any large deposit that is in a bank statement that you supply us, a large deposit will be anything over 50% of the income that we're showing for you. So I like to give examples. Let's say that you make $10,000 a month for easy math. If there's a deposit in the statement that you provide us of $5,000 or more, I'm going to question it and say, okay, Mrs. Smith, where did this $5,000 come from? If we can prove it started from you or originated from you via bonus or commission or whatever it might be, sale of stock, that's perfectly fine. If I can't source it originated from you, then I cannot use that as sourced and seasoned. So as the example I always give, if Great Aunt Alice provided you or gave you $50,000 and said, here you go invest in real estate, then while that would be great, I cannot see that deposit. So it would have to sit there for 2 months to where you supply me with 2 months of bank statements. The deposit is not listed, simply the balances are there, and that would be fine. Otherwise, you can't use it. That's sourced and seasoned. The other piece to assets that you need to remember is the reserve requirement. The reserve requirement is a little bit different. I'll go over this quickly. We do have a cheat sheet for this, Keith. If you want, I can send it and you can distribute it. They can certainly ask us for it and we can send it over. The reserves are going to be a percentage of the unpaid principal balance of the rental properties mortgages only. Okay. The percentage is going to range between 2, 4, or 6%. The number that it ends up being multiplied on will depend on how many finance properties you have. The first bucket for guideline is if you have 1 to 4 finance properties, you're going to add up the unpaid principal balance of the rental properties and multiply that times 2%. The second bucket is for 4 and 5 finance properties. You're going to take the sum of the unpaid principal balance of rental properties only and multiply by 4%. And then for those that have 7 through 10 finance properties, you add up the sum of the rental balances, mortgage balances times 6%. And then whatever those numbers are, you must add 6 months worth of PITI for the subject property. I'm going to just quickly give the worst case scenario with round simple math.
Okay.
You're purchasing your 10th investment property. Okay. Property number 1 is your primary residence. Now, while that property must count in the number of finance properties, the amount of unpaid principal balance on that mortgage is not included in the math here. It just counts as the number of financed. So again, you're purchasing your 10th investment property. This property has a PITI projected, principal, interest, taxes, and insurance projected, of $1,000 a month. 6 months of PITI. So 6 times 1,000 is $6,000. That's our subject property. Properties number 2 through 9, those are the rentals. In this easy example, they have an outstanding unpaid principal balance of $100,000 each. We have $800,000 of unpaid principal balance times 6% is $48,000 plus $6,000 is $54,000. That would be the way that you're going to calculate your reserves. The last thing I'll give you on reserves is that it can be liquid or non-liquid can satisfy the reserve requirement. So your 401k, your whole life insurance policy, your self-directed IRA, and liquid, if you needed to use it and you're checking your savings account, perfectly fine. All of those can satisfy the requirement of the reserve. And then finally, debt to income ratio. I'm just going to focus on a W-2 wage earner for this because self-employed could get a little bit crazy and squirrely. You'll want to call us directly for those numbers and formulas. 50% is the max threshold to qualify. So if you made $120,000 a year, you have $10,000 a month of income. $5,000 a month maximum has to cover all of the monthly liabilities that we will find on your individual credit report.
Right. Okay. So, for example, the minimum monthly payment on your credit card would go into that $5,000 sum of one's monthly debts.
Right. I don't care what the balances on those credit cards are. All I care is what shows as the minimum payment. And we really only care about the credit report minimum payments. So people think that their ordinary living expenses like food and gas and utilities and cell phone bills play a role. They do not. There are 3 exceptions that must be included in a DTI that won't be found on a credit report. They are if you're a renter, that primary housing expense has to go in there, HOA dues on a property, and any taxes and insurance that you pay separate from a mortgage that you had secured, right? If you're paying your taxes directly to the county or your insurance directly to the agent versus having it wrapped in your mortgage, those have to be in there too. Otherwise, it's a simple division of income versus monthly on the credit report. 50% is the threshold.
Okay, we've been talking about conventional loans at those best rates and terms, which sometimes we refer to as golden ticket loans because the terms are so favorable. And this is for your first 10 non-owner occupied income properties, single, or first 20 married. How much worse do the terms get when we go beyond 10 or 20, Chaley?
We're seeing the margin narrow a little bit between a conventional and a non-QM or a debt service coverage ratio loan, for example. Again, the characteristics are key, and those variables per the transaction, the loan to value and credit score and all of these things. Right now, I'm going to say roughly a percentage point. So if you're at 5% on a conventional for those variables and characteristics, you're going to be probably around 6% after the 10. All
right, that's really good to know. Well, Chaley and I have more to discuss about cash out refis and whether or not appraisals are keeping up with this higher appreciation environment, and also an alternative way to qualify. You're listening to Get Rich Education. Our guest is Ridge Lending Group President CEO Chaley Ridge. More when we come back. I'm your host, Keith Weinhold.
Americans are not saving for retirement. It's going to get worse as people live longer, so you need to think differently, but you can't lose your time. Real estate is the investment vehicle that has created more million and billionaires than anything else. Get Rich Education is one of America's top investing shows disrupting Wall Street. Your host, Keith Weinhold, is a true financial educator and has been an income property investor since 2002. Get Rich Education has created millions in passive monthly income for its followers. Now, Keith has a free course. Real Estate Pays 5 Ways. Sign up now at getricheducation.com/course. Invest in what produces income for you now and later. Use the link in the description to take the course for free. Real Estate Pays 5 Ways. Get Rich Education is on every podcasting platform and has its own native iOS and Android apps. Join Get Rich Education Nation to create financial freedom through real estate investing. Subscribe wherever you listen.
Welcome back to Get Rich Education. We're talking about financing, such an important part of investing. Oftentimes, 75 to 80% of your property cost is tied up in the financing and getting those terms just right. And Chaley, now that we've seen this run up in appreciation of properties, we have higher interest rates, but then, of course, the flip side of that is there is more of this equity for an investor to go for and liquefy to do whatever they want with it. So just talk to us more about the cash out refinance climate today.
Industry-wide, refinances are down for most people. However, for investors, I'm noticing we haven't really missed too much of a beat there. The more seasoned or savvy investor understands the mechanics of this, that even while they may be increasing an interest rate, borrowed funds are non-taxable, right? And utilizing that to acquire more investment properties with that extra cash flow, I would say that it's real important for the individual to just do the math, right? Figure out what is the increase in monthly payment versus what they're getting out of it and what they will take it and transition it into. The math does not lie. So just do the work, right? Crunch the numbers and figure out if it makes sense based on the variables I just described. More often than not, I think that investors find that the cash out, especially with the availability of that equity, is worth it, rather than just leaving it there to do what? Nothing.
Exactly. When one realizes that the return from home equity is always zero, and to your point, the IRS classifies a cash out refinance as a tax-free event, that often makes people want to go ahead and take advantage of that accumulated cash in their property.
And if I might interject too, remember, you have to do the numbers, and I may be splitting hairs a little bit here. You're able to deduct the mortgage interest that you're paying. So if you're paying interest on 3% versus 5%, there's a secondary incentive. It's not going to be massive, but if you're going to do the math, you might as well take it all the way to its conclusion and include that piece as well.
Oh, that's a really good point. Now, whether one's doing a cash out refinance or a new purchase of income property, of course, that lien holder is going to require an appraisal. And how are we looking with appraisals today, Chaley? In this higher appreciation environment, are appraisals able to keep up? If they're not, are people willing to pay cash to make up that gap? How does that look?
That question is largely specific to the individual market and sometimes even the neighborhood, but I am finding more, it's less common that we're seeing short values. Appraisers aren't really going to, and there's some algorithm within what they are required to produce. But if the purchase price is $100,000, but the real market value might be 150, you're getting a steal. You'll rarely see an appraisal that actually gives you a $150,000 valuation. They're going to keep it closer to the actual purchase price for whatever their requirements or guidelines or regulations are. On a refinance, we're finding that they come in at the estimated value that we put in with the order. We're not really seeing too often, maybe we did a few years ago, shorter values where that would be an issue. So I think that it's starting to catch up with itself, the appreciation. There's certainly some markets still that haven't quite caught up with that appreciation in the actual recorded sales that we need to use as the market value comps. The only thing that I would mention, though, that we are kind of finding as a hit and miss, you're probably aware of this too, Keith, is that short-term rentals, right, the more vacation rentals and that type of income as it relates to an investment property appraisal, because remember, an investment property appraisal comes with additional forms, one of which is called a 1007. This is simply the number on the page of the form. It's rental income comps. We get to give you a portion of the rental income to offset the new mortgage payment. As such, if it's a short-term rental, there are appraisers that have not really caught up to this and providing true short-term rental income. What they're going to do is they're going to be providing the long-term rents for such a property. And that may be enough, but if you're purchasing a higher end property, I have a scenario right now. Let's use it as a case file. It's $1 million property in Missouri, actually, and we're having a more difficult time finding an appraiser that understands the short-term rental income that we need to use to offset this much larger mortgage. So as far as appraisals go, I would say that if there's anything I'm observing right now, it's that the appraisers are taking a little bit longer to catch up with including the short-term income comps within the appraisal.
I'm selling a property right now, and I've had to wait longer for an appraisal report to come in than I've ever had to in my entire life. So, well, Chayla, earlier here in the discussion, you had talked about those terms required for a conventional loan, but there's an alternative way, a DSCR, a debt service coverage ratio program that you can tell us more about, which is interesting because I sort of think as debt service coverage ratio is that sort of qualification criteria that comes from the 5+ unit apartment world, but now you're applying it here to the 1 to 4 unit income property world. So tell us about that DSCR.
So this product is they're coming in hot. We're getting such huge demand for this loan. And I think that it's a combination of things. One, either the individual just can't fit into the conventional loan box, or two, they've maxed out their 10 golden tickets or whatever it may be. Or maybe it's that they simply are not wanting to go through the extra. I was going to call it brain damage, but I've already said it. So the extra vials of blood and DNA that comes in with
Right.
qualifying for a conventional mortgage, right? Anybody that's gotten a conventional mortgage is resonating with that statement. The debt service coverage ratio is all about the property. It's probably the easiest loan an investor is ever going to get. It's still a 30-year fixed product. We're going to take the gross rents, again, from the appraisal, and we're going to divide them by the proposed PITI. If that division yields a 1.0 to 1.49%, the property qualifies for this loan. The truth is that the product can actually go to a 0.75 debt service ratio, but the interest rate really goes up from there. So the baseline is 1.0 to 1.49. Gross rents from the median on the appraisal divided by the PITI. 30-year fixed mortgage, 80% loan to value, no income documentation whatsoever.
Wow.
You're simply going to need an ID, insurance, and some assets that show where your down payment or your reserves might be coming from. The seasoning of those assets is only 10 days. Conversely, looking at a 60-day seasoning on a conventional loan. The product will go as low as 600 credit score. Actually, 70% would be the max loan to value on that guy, but from 600 to 740 credit score, you can expect varying interest rates and loan to value maximums. It's been pretty popular.
Okay, so it sounds like the DSCR, they still do look at the borrower, for example, their credit score a little bit. However, it's primarily based on the rent income that the property provides. So the DSCR, in short, is prioritizing qualification of the property's performance over the borrower's performance.
Correct.
Now, I would imagine that perhaps some estoppel certificates would be required with the DSCR since it's being qualified primarily on the rent income that the property produces.
I'm not sure. I don't know that is the case, actually, Keith. I'd have to go back and look at the fine print within the guidelines. I have not heard that come up yet. We launched this mid last year. That doesn't sound familiar. That has not come across my desk as an issue with any of these yet.
Okay, but this DSCR program, this has been a good alternative for people that cannot get into that conventional box that we described earlier, or for people perhaps that want to get more than 10 loans.
Right. Or just don't really want, they're okay taking the higher interest rate because they just don't have the patience for what goes into a conventional loan and what's required.
Yeah. Well, Jay, this has been a great, well-rounded conversation about what's going on with the mortgage lending environment today and what it takes to qualify for a loan. Are there perhaps any last things that people should know with qualifying for a mortgage loan for income property? Maybe something I did not think about asking you?
I would say that we're finding ourselves here. We're getting close to tax time. So if you need some strategy or some advice from your lender about how we want that Schedule E specifically to look, feel free to check in with us. We can start the strategy and the planning, taking a look at draft tax returns for you to make sure you're optimizing that piece. Because as most of you have heard me say, of all the different criteria to qualify, the debt to income ratio, especially for an investor, can get away from you before you even realize it. So that's a real value add I think that Ridge provides for its clients, is the strategy and structure specific to looking at Schedule E's and income and things like that. So be sure to let us know how we can help. Call us, email us, check out our website, ridgelendinggroup.com. Toll free 855-74-RIDGE is an easy way to remember. Or email is info@ridgelendinggroup.com.
Yeah, and you keep growing. You now offer loans in 46 states. So the best way for you to get started with an income property loan yourself is at ridgelendinggroup.com. Chaley Ridge, it's been valuable as always. Thanks so much for coming on to the show.